The silver market is sending a signal so powerful, so structurally undeniable, that ignoring it would mean missing one of the most important financial warnings of 2025. What we are witnessing right now is not a temporary liquidity issue, not a momentary mismatch between buyers and sellers. It's a systemic fracture. When dealers begin shutting down, when refiners stop accepting metal, when inventories collapse across global vaults, that is not noise. That is the market revealing a truth that has been building for years beneath the surface, and today that truth has finally broken through. For more than a decade, we have operated within a framework that assumed silver supply would always be available. Mines would produce, recycling flows would continue, dealers would always maintain inventory, but that assumption is now proving dangerously outdated. Global demand, driven by solar energy, electronics, electric vehicles, and industrial applications, has surged far beyond expectations. The world is moving toward electrification faster than traditional forecasting models ever projected, and silver is at the center of that transformation. Yet mine supply cannot accelerate at the same pace. The geological, logistical, and financial constraints are far too rigid. So we now have a structural deficit, not a seasonal one, not a cyclical one, a deep, persistent, multi-year deficit in which consumption continues to exceed production. The inventories that once filled the gap have been drawn down, year after year, to artificially stabilize the market, but 2025 is the year when the system finally ran out of buffer. Vaults that once held hundreds of millions of ounces now show some of the lowest levels in modern history. And without inventory, the entire downstream chain begins to seize. That's exactly why dealers are shutting down. They cannot buy what refiners won't process, and they cannot sell what wholesalers cannot supply. This is not a business decision. It is a survival mechanism. When the physical market freezes, paper markets lose credibility, and we are watching that credibility erode in real time. Futures pricing is now disconnected from physical availability. On paper, silver trades freely. In the real world, it's becoming scarce. This divergence is crucial. Historically, such disconnects have preceded major repricings in commodities. When the financial system values an asset one way, but the physical world signals something entirely different, the correction often comes suddenly and decisively. That is the warning embedded in this crisis. The market is telling us that silver, an asset essential to both high-tech innovation and global energy transition, is no longer being priced according to its real-world importance. The shutdown among dealers is not the crisis itself. It is the symptom. The root cause is a decade of underinvestment in mining, an accelerating demand curve, and a global shift toward technologies that consume more silver per unit than any previous generation of industrial infrastructure. Meanwhile, investors seeking safety in an uncertain macro environment are turning back to tangible assets. These forces are converging at the same time, tightening supply to levels the market is no longer able to absorb. When we study disruptive moments in financial history, one pattern stands out. Markets rarely warn twice. They send a single, loud, unmistakable signal before a major shift occurs. This shutdown is that signal. It's telling us the old pricing mechanisms are breaking. It's telling us that physical scarcity is becoming impossible to ignore. And it's telling us that 2025 will be remembered as a pivotal year in the silver market, one in which investors who were paying attention positioned themselves early, while the rest waited for clarity that would come too late. This is not fear, this is data, and the data is clear. Silver is entering a new era, and the market will not look the same on the other side of this crisis. The silver market is reaching a pressure point that has been building for years, and now the system is finally cracking in full view. What we are seeing is not a routine slowdown, not a cyclical correction, but a full-scale freeze. Dealers aren't stopping sales because of sentiment. They are stopping because the physical supply chain can no longer support normal market operations. And when the physical market freezes while the financial market continues trading freely, that tells you something incredibly important. Reality is diverging from price. Whenever that happens, a major repricing is no longer a possibility. It becomes an inevitability. For years, silver's role in the global economy has been misunderstood. It has been treated like a traditional precious metal, priced largely on investor psychology and macroeconomic conditions. But the real story is structural and deeply technological. Silver is essential for solar photovoltaics, medical devices, electronics, electric vehicles, advanced batteries, and emerging energy systems. It is one of the most conductive materials known to science, and its utility is irreplaceable in many of the industries driving global innovation. As these sectors scale, their consumption of silver rises exponentially, not linearly. This is where the imbalance begins. Global mine supply has been stagnant, held back by underinvestment, declining ore grades, and rising extraction costs. Recycling flows are inconsistent and insufficient, especially now that so much modern technology uses silver in small quantities that are not economically recoverable. In other words, demand is scaling exponentially, while supply is stuck in a slow, constrained trajectory. The result is a structural deficit, one that has persisted year after year. These deficits have been masked by massive draws from above ground inventories. That was the hidden safety valve, but today that safety valve is failing. Major vaults and exchanges have seen consistent, steep declines in physical silver reserves. Inventories that once provided stability have been siphoned off to meet the growing gap between supply and consumption. And now we have reached the point where dealers, who rely on wholesalers, refiners, and industrial suppliers, simply cannot replenish stock fast enough to meet normal consumer demand. That is why they are stopping sales. They are not choosing to, they are being forced to. The system is telling them there is no metal left for you to sell at these prices. Refiners are backed up, mints are delaying releases, wholesalers are rationing supply. This is what a freeze looks like long before the mainstream financial narrative catches up. When you see the physical market contract this aggressively, you must understand what it means for pricing. Financial markets can ignore physical constraints for a while, until they no longer can. This disconnect between the paper market and the real market has appeared before in other commodities. Every time, the correction has been abrupt and decisive. And every time, it has caught traditional investors off guard. What's happening now in silver is a classic early signal of a system-wide repricing. The freeze among dealers is not a peripheral issue. It is the front line of the broader structural reality. If dealers cannot source supply, the entire downstream market becomes impaired. And once retail access breaks down, institutional players begin questioning their assumptions. When the confidence in physical liquidity collapses, the financial market must eventually revalue the asset to reflect true scarcity. This moment is not defined by fear, but by data. The numbers are revealing a market that has outgrown its old pricing model. Silver is no longer simply a hedge or a speculative asset. It has become a critical industrial resource at the center of global technological transformation. And whenever an asset's utility becomes more important than its price, a shift in valuations becomes unavoidable. The freeze is the signal, and those who understand disruptive cycles know, signals like this don't repeat themselves. They appear once, they announce the change, and then the market moves. The silver market is under a strain so intense that what we once accepted as normal operations for dealers and refiners is now unraveling, and the cracks are showing everywhere. Across vaults from London to Shanghai, physical silver inventories are draining at unprecedented rates. In China alone, stocks held in major exchanges dropped by more than half in just 7 weeks. Oh, bullion +1, this isn't a cyclical blip. It's a structural collapse. For several years, global silver demand powered by solar energy infrastructure, electric vehicles, electronics, and green energy buildouts has consistently outpaced mining output and recycling combined. Physical gold +2 Wedbush investors +2 production has been constrained not only because much silver comes as a byproduct of other metal mining, but also because declining ore grades, rising extraction costs, and underinvestment in new silver projects have throttled supply growth. Metal News +2 Wedbush investors +2 the result, a multi-year supply deficit that has steadily eroded above ground stockpiles. Discovery Alert +2 Mint State Gold +2 as those inventories vanish. Dealers the link between mines, refiners, and end buyers are being squeezed out. Many are no longer accepting new silver scrap or bullion because refiners are backed up, processing is delayed, and wholesale inventories are frozen. In some markets, jewelers and bullion traders have already suspended new silver sales and halted orders. The Economic Times +2 Reuters +2 in practice, this means what used to trade freely as silver has become a scarce, tightly rationed commodity. Physical delivery premiums are soaring relative to paper contracts or futures. Those wanting immediate delivery now face higher costs, long delays, or outright unavailability. Wapacone to Daily News +2 Cryptometer +2 This is more than a supply shortage. It is a reset, a forced recalibration of the silver market's fundamentals. The traditional model, where paper silver contracts and future promises stood beside physical metal as roughly equivalent, is cracking. Paper-only positions are becoming increasingly hollow as the physical market dries up. What's most striking is that this isn't driven by volatility or speculation, it is driven by demand and utility. Silver is at the heart of the global push toward electrification, renewables, high-tech manufacturing, and infrastructure build-out. As those sectors accelerate, the demand for real, physical silver only increases, and there simply isn't enough supply to meet it under current conditions. Physical gold +2 Coin World +2 So dealers are not choosing to shut down operations, they are being forced to by reality. The supply lines have snapped, the inventories are gone, and until new supply from new mines, major recycling breakthroughs, or dramatic reductions in demand emerges, this freeze will hold. This collapse is a wake-up call. It signals that silver may no longer be a commodity you can take for granted. It is becoming a strategic resource, one whose true scarcity is now unmasked, whose value may be fundamentally redefined, and whose availability may become a privilege, not a guarantee. What's going on behind the headlines is far more serious than what most people realize. The silver market is undergoing a fundamental transformation, and the wheels are already coming off. The supply chain that once reliably delivered silver to dealers, refiners, industries, and investors is cracking, and the silence around this makes it even more dangerous. For years now, global silver demand, especially from industrial sectors like solar energy, electric vehicles, electronics, and infrastructure, has been growing relentlessly. Physical gold +2, the Economic Times +2 at the same time, supply hasn't kept up. Mining output remains essentially flat, and much of silver comes as a byproduct of mining other metals. That means even if prices rise, silver production can't simply scale up the same way as a pure silver mine would. The Pilot News +2 Discovery Alert +2 add declining ore grades and rising extraction costs to the mix, and the supply base becomes even weaker. The Pilot News +1 Recycling, once a modest buffer for supply, can't fill the gap either. Much of the silver used in modern technology ends up in small, dispersed components that are economically impractical to reclaim. Physical gold +1 meanwhile, above ground inventories, the hidden buffer that masked deficits for years, are being drawn down rapidly. Metal News +2 Mint +2 Now, the supply squeeze has intensified to the point where physical silver is becoming scarce not just for industrial buyers, but for dealers and bullion traders too. Vaults in major trading hubs are showing dramatically reduced holdings. Physical gold +2, invest +2 silver lease rates, the cost of borrowing physical metal have surged, often to levels indicating extreme stress rather than normal market conditions. The Pilot News +2, the Economic Times +2 in that environment. Dealers, those who buy from refiners or wholesalers and sell to investors, retailers, or industrial users, find themselves facing a harsh reality. There simply isn't enough deliverable silver to meet demand. Refiners are overwhelmed, scrap supply has dried up, and new mine output can't respond quickly. Discovery Alert +2 Discovery Alert +2 Many dealers are being forced to stop taking new orders or pause operations entirely, not because of pessimism, but because supply has run dry. What's worse, the disconnect between paper promises and physical reality is threatening to unravel trust in the whole system. Futures contracts, ETFs, and other paper-based silver investments are still being traded, but when so little metal is physically available for delivery, those paper claims begin to ring hollow. Backwardation, where spot silver trades at a premium over futures, has become more common, a classic signal of real scarcity. The Pilot News +2 Metal News +2 This isn't a short-lived spike or a typical commodity cycle. This is a structural crisis, a multi-year deficit, accelerating industrial demand, near stagnant mine supply, depleted inventories, logistical bottlenecks, and geopolitical headwinds all converging. Mint +4, physical gold +4, Discovery Alert +4. And because much silver is mined as a byproduct, the market simply lacks the flexibility to respond to price signals. The rules have changed. What you're seeing now: dealer closures, halted orders, surging premiums for immediate delivery, they're not anomalies. They're the beginning of a new paradigm, one where physical silver becomes far more scarce relative to demand, where paper contracts and metal holdings diverge, and where the true value of silver as a critical industrial metal in a global energy and technology transition gets reflected not in prices shaped by speculation, but by real-world scarcity. If you follow this carefully, you'll realize this shutdown isn't just about market panic or hype. It's about fundamentals and what's not being told. That for many, access to real silver, physical, deliverable silver, may soon become a rare privilege.